Hi, this is Professor Margolis, and here is a review of some of what we were discussing tonight. For starters, there is future value. So, future value is basically if I have $100 today, what can I earn on that money over the next year? Once we determine what I can earn on that money over the next year, we know what that money should be worth in a year. So say the interest rate is 5%, and I can put the money in the bank at 5%, then $100 today should be worth $105 in a year from now. On the flip side, if I tell you I will give you $105 in a year from now, we know that $105 in a year from now is worth $100 today. You should be willing to pay me $100 today in order to get $105 in a year from now. Present value is the $100 today. $105 is the value of this asset or investment in a year from now. It's worth you paying this amount of money today in order to get that amount of money tomorrow. Now, those are nice round numbers. Suppose I tell you you're going to get $100 in a year from now. What is that worth today? Well, we could use the same type of formula. So let's go back to the $105 in a year from now. $105 in a year from now, we would be discounting that at 5%. And so we discount that at 5%, we get $100 today. So if we know it's worth $100 in a year from now and we discount that at 5%, that gets us to around 95, a little bit more than 95%. Or if we're talking about $100 in a year from now, it'll be worth a little bit more than $95 today. Now, continuing in our example, suppose I tell you I'm going to give you $100 in a year from now and $100 in 2 years from now. Now, how much is that worth? You're getting $200, $100 in a year from now, another $100 in 2 years from now. So, well, we can figure that out. We could say, well, we know the interest rate is 5%. $100 in a year from now is worth $95. The $100 in 2 years from now is going to be worth around $90, probably a little closer to 91. And together we can add that up and we'll come out with approximately $185. So you would pay $100 today to get two $100 payments, one in 1 year, one in 2 years. Now, if you want to extend this out and do this for many payments, you want to do this for 10 payments or 20 payments, you're going to get a lot of $100 payments. Say you're looking to purchase an annuity, right? An annuity is a stream of payments. You're going to get paid a certain amount of money every year. How much is that worth? Or let's say you have a bond. Now, a bond has two components. A bond that you buy today, let's say the bond is par value, selling at fair normal cost. The bond is being issued today. A fair cost bond, let's just work in terms of numbers of 100. The bonds are usually in 1,000 or 5,000 increments. Let's say you were buying a $100 bond that paid $5 a year. How much is that bond worth today? Well, if interest rates are 5%, that bond should be worth $100 today. Okay? So a bond might be paying you interest for 30 years. So you would pay $100 today. You'd get paid $5 every year. And at the end, you'd get your $100 back. And if interest rates are 5%, that bond would be priced at 100. Now, as I was saying, a bond has two components. There's the stream of payments, the $5 that you're getting every year, and then there is the $100 payment that you're receiving at the end of the 5 years, at the end of the 30 years, or whatever the term of the bond is, in this case, 30 years. So if you're receiving $100 at the end of the 30 years and $5 every year, together, the present value of that $100 payment, which would be discounted at 5% for 30 years, and the present value of that stream of $5 payments, which are also being discounted at 5%, value of that whole package would be worth $100 today. So let's assume that we got that right. There are those two components. How much? Okay, so we have the two components of our bond. let's talk for a moment before we get back to the present value cash flow streams. Let's discuss what happens to a bond when the interest rate changes. So remember, what all this is built on is what is the value of that $100 payment in 30 years? What is the value of that stream of $5 payments over the next 30 years? That's what we're trying to figure out. So the value of that payment, if interest rates are 5%, the value of all those payments together is $100. But what happens if we issued that bond today? Interest rates were 5%. The bond was worth $100. Now, tomorrow, let's say interest rates go up. What that means is if you have $100, you can go and buy a bond paying $6 a year or $7 a year, some higher amount. So what's the value of this existing bond? We have the bond, right? I already have this bond. Would you pay $100 for a bond that's going to pay you $5 a year when you can go down the block to my neighbor and buy a bond from him or her that would pay you $6 a year or $7 a year plus the $100 at the end? No, you would not. You wouldn't pay me $100 for my bond. My bond is no longer worth $100 because $100 will buy you something much better. The value of my bond will go down until the point where the rate of return which you would get on my bond is equivalent to the 7% that you can get anywhere else. And so the value of my bond would be something less than 100, maybe 90, maybe 80. We could do the math. On the flip side, if interest rates went down, what that means is that when you had $100 and you wanted to invest $100, you wanted to buy a new bond for $100, you would only get paid $2, let's say. Whereas my bond is paying you $5 a year. So what's going to happen to the value of my bond? Well, the value of my bond will go up. You'll pay more for my bond because you know that my bond will pay you $5 a year and the other bond will pay you $2 a year. You'll pay enough more for my bond so that the value to you of my bond works out to around 2%, which is the value that people are paying in the market. You wouldn't pay $100 for my bond, you might pay 120, 130, whatever it is, so that investing 130 and getting this stream of payments would pay you whatever it is that you needed to get paid, which in this case is 2%. Okay, so now back to what we said about bonds. Bonds have two components. There is the fixed payment at the end, and then there's the cash flow stream over the period of time. Now, when you issue the bond, if rates are 5%, you might agree to pay $50 a year, or that's for $1,000. You might agree to pay $5 a year, and that's okay. A bond that pays $5 a year is giving a return of 5%. So if interest rates are 5%, a bond should be paying $5 a year. But once that bond is issued, it will continue to pay $5 a year for the next 30 years, assuming there's no default. And that's just how it is. It doesn't make a difference what happens to interest rates. So now the value of that stream of payments will go up or down based on market interest rates. It'll still be the same $5 a year getting paid by the issuer, by the borrower, to whoever is holding the bond, but the value that someone might be paying for that bond in the secondary market will go up or down based on interest rates. So now that we understand that, we can really go back to an annuity. Whatever an annuity is, that annuity will be discounted at some rate. And that rate is going to be heavily influenced by interest rates. It could be influenced by the credibility of the annuity issuer. So say interest rates are 5%, but you're a little nervous that this issuer might go bankrupt. Well, maybe you'd want to discount it at 10%, right? In an annuity, imagine, again, a payment, if you're getting $110 in a year from now and you require 10% rate of return, you'd pay approximately $100 for that. If you need $120, if you need a 20% return, then you'd need to be getting $120 for it to be worth paying $100. Now, suppose you need a 20% return, but this annuity is only paying $110. Well, then you wouldn't pay $100 for that today. You'd pay somewhat less. Maybe you'd pay $90, probably a little bit more than 90, maybe 91 or 92. So that's for one payment. But you really have the same kind of concept for multiple payments. You have to look at the payments and you have to look at the rate at which you need to discount those payments. How much less is it worth today? And the proxy for that is how much could I be earning if I had the money today? That's the rate on some level that you really need to be achieving. And so for a payment in 1 year of $100, if you could have earned 5%, you're only going to pay around $95 for that. For a payment 2 years from today, what rate will you pay? Well, for a payment 2 years from today, you'd pay around $90, assuming you could earn 5% a year. And so what rate would you pay for an annuity of $100 for a period of 30 years? Now remember, that's a 30-year, $100 that you're receiving in 30 years, discounted at 5% a year for 30 years. $100 that you're receiving in 29 years, discounted at 5% a year for 29 years, plus $100 that you're receiving in 28 years, discounted at 5% a year for 28 years, et cetera, et cetera. So incidentally, the total amount that this comes out to is approximately $1,500. So you're basically paying 50 cents on the dollar. But the reason for that is because that payment in 30 years is not worth very much. The payment in 1 year is worth 95 cents on the dollar. The payment in 2 years is worth 90 cents. The payment in 3 years is worth maybe 86 cents on the dollar, and so on and so forth. That payment all the way out is probably only worth 50 cents on the dollar, give or take. No, it's probably worth a lot less than 50 cents on the dollar. Probably around 20 or 30 cents on the dollar. And this is the story. If you have any questions, please reach out. And if you are my students watching this video, please take a look at the book. Like I said, probably page 200 to 220 will give you more insight on this. Have a good evening. You know what? I'm going to add one more thing. There's also the future value of an annuity, which is a similar kind of thing, but a little bit different. It's basically how much will you have if you have this annuity, how much will you have at the end? So instead of looking at an annuity coming into you, look at an annuity going out. Say you're funding a retirement account and you're putting money in and you don't care what anything is worth today. What you're really trying to figure out is how much money will you have at the end? And it's a similar kind of thing. You're basically looking at the future value. The money you put in today, what will that be worth in 30 years? The money you put in 1 year, what will that be worth 29 years later? The money you put in 2 years from now, what will that be worth 28 years later? And so we have factors. You can look at the charts and tables, but basically that's the idea. And if you're putting in the same amount every year, and you have a reasonable assumption of a fixed rate of return or some approximation, then you can use the future value of an annuity table, which will give you a number by which you can multiply that. And that will be a number in a positive interest rate environment. That number will be somewhat more than 1. So the future value of an annuity at 5% a year for 30 years is going to be a number well above 30. Because 30 would essentially mean that you're putting $100 in every year, and that's only worth $3,000 after 30 years, which means you haven't earned any interest. So I would say the number is probably well above 60. But let me look it up on the chart. Future value interest factor of an annuity at 5% for 30 years is 66. So if you're putting in $100 a year for 30 years, you will have put in a total of $3,000, but at the end of 30 years, at a rate of 5%, your investment will be worth $6,600. So that's more than double what you've put in over a period of 30 years. And the real beauty of playing with the interest rate is if you have an interest rate assumption of 7%, that is worth $9,400. If you assume that you're going to earn 10%, which is a little bit expensive, especially considering the market that we're in now. That will be worth $164. So sometimes when people tell you we have a projected return of something, the difference between a 5% return and a 10% return is about 3 times as much money, almost 3 times as much money in your account, 2.5 to 3 times as much. So be wary of those numbers. When they say, oh, well, we're going to have all this money, just make sure that their interest rate assumption makes sense. The difference between 5% and 10% is 2.5 times as much money. For the second time, signing off. Have a good evening.